Good day. My name is Dylan Talamos, and I am here today to speak to you regarding Macquarie Group Limited, ticker code MQG on the ASX, which will be referred to as the item for the remainder of the report. The item was originally listed on the ASX in early November 2007 and now functions across 31 markets. They identify as having specialist expertise in areas such as resources, agriculture and commodities, energy and infrastructure, with a particular knowledge of the Asian Pacific region. This report will briefly cover the structure of the item, recent significant events in the company, valuation and risk management protocols of the item. At time of writing, the item is trading at $159.05, which is just under the 52-week high recorded on the 26th of April 2021, with a market capitalization of $58.29 billion from 361.92 million outstanding shares. The market capitalization comes from a 12-month trailing revenue of $11.64 billion. During the 2019 to 2020 period, the item saw revenue growth of 5.63%, which is lower than the 18.33% growth seen between 2018 and 2019. However, this reduction in growth has not been adjusted to reflect the impact the novel coronavirus had on the item. This reduction in revenue, still maintained, allowed the company to remain profitable and maintain their 52-year profitability streak. Macquarie Group is a global business operating in over 31 markets, specializing in a variety of sectors including resources, agriculture and commodities, and energy and infrastructure. The item is split into 4 businesses that make up the foundation of the group, being Macquarie Asset Management, Banking and Financial Services, Commodities, and Global Markets, and Macquarie Capital. This diversification provides access to a multitude of financial services and sectors, including asset management, retail and business banking services, risk and capital solutions, corporate advisory, capital solutions, and equity sales, creating a well-rounded business with multiple diversified points of growth. These 4 sections of the business are further supported by 4 support services available to all sections of the item to ensure that the whole item is operating in line with the entity's goals and ideals. These 4 support groups are corporate operation, risk management, financial management, and legal and governance. This diversification and support structure creates for a solid foundation that allows the item to continually grow and adapt, as well as be seen in the model and multiple sections later. The most recent move made by the item was the acquisition of Waddell & Reed Financial Incorporated, ticker code on the New York Stock Exchange is WDR, and the selling of Waddell's & Reed's wealth management platform to LPL Financial Holdings Incorporated, ticker code LPLA on the New York Stock Exchange. This transaction means that the item retains Waddell & Reed Financial Incorporated's asset management business, increasing managed assets by $76 billion and beginning a long-term partnership with LPL Financial Holdings Incorporated. The item is committed towards an environmental sustainability and a reduction of greenhouse gases, demonstrated by the item's commitment exceeding $60 billion invested in green energy since 2010. Additionally, they support more than 46 gigawatts of green energy projects in development, constructions, or operation. Among the multitude of other commitments upheld is their participation in the global environmental and sustainability projects, including joining the Japan Climate Leaders Partnership as a supporting member, as announced on the 14th of April 2021. While the Macquarie Group has many merits supporting the item, the stock price of the item is situated best for a sell verdict. According to the item's 2020 financial report, the intrinsic value of the firm's equity was sitting at $44,720.83 million from 361.52 million outstanding shares, resulting in an individual share price of $123.7. This valuation differs distinctly from the market value of $155.05 per share at time of writing, valuing the item's market equity at $60,705.18 million. This reflects the overall market currently, with all ordinaries currently seeing a 5.3% growth at the year to date, peaking at 8.3%. The item peaked at a 16.3% growth year to date, the 4th of May, has since dropped to 11.8%, reflecting a relatively bullish attitude that is gradually dropping. Despite having dropped, it is still well above the estimated required rate of return of 5.44% according to the capital asset pricing model. This overpriced valuation is supported by the price-to-earnings ratio currently sitting at 18.99, but also indicates shareholders' belief in the company's potential and ability for strong growth. This price-earning ratio is similar to that of the Big Four banks, whose price-earnings ratios are 16.43, 19.6, 20.89, and 21.3 respectively, supporting my earlier statement that the market as a whole is currently bullish, but can be expected to stabilize. Because of this bullish attitude in the market currently, it is an ideal time to sell or short with the intention of monitoring the item for potential future buy periods that will inevitably arise from the item's strong merits, as mentioned above, the strong positioning of the item's financials. The item currently has a return on equity of 66.08% and a return on total capital of 44.71%. The debt-to-equity ratio of 19.02%. This indicates a strong profit potential with limited risk due to less than a fifth of the item's assets being funded by debt, a figure which is supported by an equity multiplier of 15.2. The item currently has a profit margin of 25.69% and an operating profit margin of 27.34%, which is sitting on par or slightly below the Big Four banks' trailing 12 months ratios. It must be noted, however, that the trailing 12-month ratios utilized for the Big Four banks do not include the novel coronavirus-inspired market crash of March of 2020, but the ratios of the item do include this data. This is significant as this shows quite a respectable performance, as all ordinaries dropped by over 32% in that period, and the item has managed to recover from this drop quite strongly. The item has a respectably conservative balance sheet with a current ratio of 58.69%, quick ratio of 37.5%, and a cash ratio of 22.35%, indicating a strong ability to meet a potential increased demand on consumer deposits. This also indicates that the entity is following all regulations regarding capital management as legislated for financial institutions. Due to the international outlook of the item and the item's operations in both the general finance sector and as an authorized depository institution, it is exposed to a variety of risks. These include credit, liquidity, business, interest rate, foreign exchange, and political. However, as it is an authorized deposit-taking institution in Australia, it must meet the rigorous risk management procedures that are enforced by both the Australian Prudential Regulation Authority and the Australian Securities Investments Commission. These regulations, in place for financial institutions, due to the important role they play in the economy, greatly reduce the overall risk of an institution in a multitude of ways, including but not limited to corporate governance, auditing, and liquidity management. The transparent nature of their 2020 annual report demonstrate that the item meets all relevant regulatory requirements. The overview of the board's actions, including a review of the remuneration processes for the board and other non-executive members, and detailed risk management protocols, ensure all actions are for the benefit of shareholders. Furthermore, the item also provides a breakdown of its capital portfolio, comparing it to Basel III and APRA standards, and as a breakdown of its risk framework and funding and liquidity management. To finalize the item's style risk management, they are audited annually by a private auditing firm, in this case by Pricewaterhouse Consulting, on both their financial statements and board of directors to ensure the items meet all regulations. This rigid risk framework was mostly recently tested in 2020 through the global pandemic and, to all accounts, has proven its worth, not only guiding the entity through the pandemic, but also surpassing the pre-pandemic market price during March of this year. I would currently recommend selling or shorting Macquarie Group securities due to the intrinsic value of their stock currently being lower than the market price, and the intrinsic equity firm value being lower than the market equity firm value. This has come from a bullish attitude in the market that is demonstrated through the All Ordinary's rapid increase in strength in recent months. However, I would recommend monitoring the stock as it has significant growth potential and a lower risk, as shown by the beta of 1.15, indicating marginally more volatile returns in the market and a rigorous risk management plan in place. The item boasts a strong profit margin, debt-to-equity ratio, and return on both equity and capital that indicates the stock growth potential. However, due to its involvement in the international market and the finance sector, the market price must be closely monitored as it can easily be caught up in a bull market. Thank you.